Usually when we talk about retail, especially mall-based apparel retail, there's this, I don't know, this baked-in expectation of absolute chaos.
Oh, totally. It's usually a mess.
Yeah, exactly. Yeah. You picture this like creaky wooden ship just trying to navigate through a Category 5 hurricane.
Right.
Because on one side, you have these impossibly rapid shifts in consumer tastes. Like what's cool on TikTok on Tuesday is completely dead by Friday.
Oh, 100%. The trend cycles are just brutal now.
They really are. And then on the other side, you have these massive lumbering global supply chains.
Yeah.
Chains that literally take 9 months to turn a sketch on a notepad into an actual sweater on a shelf.
Yeah, which is just an eternity in fashion.
Right, an absolute eternity. And then you throw in, unpredictable weather, inflation, shifting energy costs. When earnings come out for these apparel companies, the CEO typically just points at the storm clouds, shrugs, and basically says, look, we did our best with the hand we were dealt.
Yeah, I mean, it's an incredibly reactionary industry. And you're right, that's kind of the prevailing narrative out there. It always feels entirely binary.
Yeah.
You either catch the trend perfectly and have a blowout quarter, or you miss it by like a millimeter and end up sitting on millions of dollars of dead inventory.
Which you then have to aggressively discount just to keep the lights on, right?
Exactly, just slashing prices to free up cash.
And as an investor, I mean, that feast or famine cycle is just exhausting. If you are putting your hard-earned capital into a stock, you inherently want predictability. You want a steady compounder.
Right, you don't want to be guessing the weather or the next TikTok trend.
Exactly.
Yeah.
But for decades, the market has essentially told us that extreme stomach-churning volatility is just, well, it's the basic price of admission if you want to buy into apparel.
Yeah, that's the standard pitch.
But then, and this is why we're here today, you step into the world of Urban Outfitters.
Yeah.
Specifically, you read through their Q1 fiscal 2027 earnings call, and suddenly that unpredictable, chaotic hurricane looks like a perfectly controlled, highly calibrated wind tunnel.
It's a completely different environment.
It really is. You realize you aren't looking at a wooden ship at all. We are looking at a retail operation that is functioning like a precision-engineered machine.
Yeah, it is the absolute definition of bucking the macroeconomic trend. I mean, what they are doing right now shouldn't really be possible given the headwinds in the broader economy.
So we are going to tear this earnings call apart for you today. This is our deep dive into the source material. No corporate fluff, no glossing over the hard numbers.
We're going straight to the data.
Straight into the data to figure out exactly how URBN, that's the ticker symbol, by the way, URBN just posted their 7th consecutive quarter of record sales and record profits.
7th? It's wild.
I want you to really process that statement for a second. 7 consecutive quarters of record-breaking numbers. Think about what the global retail environment has looked like over the last 2 years. And then imagine a mall-based retailer hitting all-time highs every single time they report.
It's almost unheard of. And, to even begin to understand how they are achieving that level of consistency, we kind of have to completely discard the outdated perception of what this company actually is.
Right, the whole mall brand stigma.
Exactly, because if you're listening to this and you're still thinking of URBN as just a singular mall brand selling like crop tops and vinyl records to teenagers, well, your thesis is fundamentally flawed.
Yeah, they are so much more than that now.
Right. They have systematically transformed into this highly diversified, horizontally integrated retail ecosystem.
Right. They aren't relying on just a single demographic to keep the engine running anymore. Break down this portfolio for us, because the way they have staged these brands is incredibly deliberate, isn't it?
Oh, it's totally deliberate. It's essentially a roadmap of a consumer's entire adult life. They've engineered these distinct brands to capture you at different life stages and, crucially, different income brackets.
Okay, so walk us through the stages.
Sure. So at the entry level, you have the namesake Urban Outfitters brand. This is hyper-targeted at that 18 to 20-year-old young adult demographic.
It's a college crowd.
Yeah, exactly. It's about trend discovery, dorm living, fast-moving fashion. But then as that consumer ages up and her disposable income hopefully increases, they don't want to just lose her to a competitor.
Right.
So they transition her into Free People.
Which ages up slightly, right? To that 25 to 30-year-old demographic.
Exactly. Free People captures that young professional woman, but with a very specific premium bohemian aesthetic. It's a distinct lifestyle brand.
Yeah, I definitely see that.
And then as she ages up again, maybe she's buying a home or advancing further in her career, they capture her with Anthropologie.
And Anthropologie is a whole different beast.
It really is. It targets the 28 to 45-year-old woman. And it isn't just apparel. It leans heavily into high-margin home goods, furniture, wellness products.
And it doesn't even stop with just those three pillars, right?
Yeah.
They also have Terrain.
Right, Terrain.
Which is their higher-end outdoor living and garden brand, catering to an even more affluent homeowner demographic.
Yeah, capturing that backyard and patio spend.
And then hovering above all of this, functioning as a completely different type of growth engine, you have Nuuly.
Nuuly is fascinating, just fascinating. It's their rapidly scaling women's apparel subscription rental service.
Right.
And it operates on an entirely different financial model than the brick and mortar stores, which we will definitely dig into deeply later.
Oh, for sure. We have to.
But the overarching point here is that URBN isn't trying to be everything to everyone inside one massive department store.
Yeah.
They have built these bespoke, highly targeted ecosystems.
So if one card struggles, the whole thing doesn't tank.
Precisely. If 18-year-olds suddenly stop buying jeans, the entire company doesn't collapse because a 40-year-old Anthropologie customer is still in there buying a $3,000 velvet sofa.
Which is such a massive buffer for their balance sheet. And that perfectly sets the stage for the actual numbers they just reported.
Let's get into them.
Yeah, let's get right into the headline data because the sheer scale here is staggering. Total URBN sales hit a first quarter record of $1.5 billion.
Wow.
That is an 11% increase year over year.
Yeah.
Now, $1.5 billion is a massive number in a vacuum, but give us the context here. Q1 is traditionally a retail dead zone, isn't it?
Oh, historically, yes. The first quarter is basically the graveyard of the retail calendar. You are sandwiched right between the massive holiday spending rush of Q4 and the lucrative back-to-school season of late Q2 and Q3.
Right, so people are just completely broke.
Exactly. Consumers are tapped out from December, they are waiting on tax refunds, and the weather is super unpredictable as you transition from winter to spring.
So nobody knows what kind of coat to buy.
Exactly. So to pull an 11% top-line growth out of that specific quarter, especially in an inflationary environment where discretionary income is really squeezed, it's genuinely remarkable for a mature retailer.
It really is.
Yeah.
But, top-line revenue is just a vanity metric if you are burning cash to get there.
Oh, 100%.
Like, anybody can sell $1.5 billion worth of inventory if they mark it down by 80%.
Right, you could just give it away.
Exactly. The real question for us is, how did that translate to the bottom line?
Well, they defended their profitability beautifully. Earnings per share, or EPS, grew 12% to $1.30 per diluted share.
Okay, so actual earnings are up.
Yeah. Their net income actually increased to $116 million, and total operating income grew 9% to a Q1 record of $140 million.
So they are moving massive volume, and they're doing it at full price. They aren't sacrificing their margins just to juice the revenue numbers, which is great.
Right, they're holding the line on price.
But there is a specific data point buried in this earnings release that I think is the loudest signal for the retail investor listening right now.
The buybacks.
Yes, the buybacks. During this single quarter, URBN repurchased 4.6 million of their own shares on the open market to the tune of roughly $300 million.
It is a massive, massive flex of their balance sheet.
It really is.
I mean, for a company of this size, spending $300 million on buybacks in a single 3-month window effectively reduced their total outstanding shares by 5%.
Let's pause and really explore the mechanics of this, because I think share buybacks are often misunderstood by, casual investors.
Oh, definitely.
If I am holding 100 shares of URBN in my brokerage account right now, what does a 5% reduction in outstanding shares actually do for me?
Okay, think of the company's total future profits as a massive pie, right?
Okay.
Every single share of stock in existence represents one tiny slice of that pie. What URBN management just did was walk into the market, buy up 5% of all the slices, and literally throw them in the trash.
Just burned them.
Exactly. They retired them. So the pie itself didn't shrink. I mean, the company is still generating record profits, but there are now 5% fewer slices in total.
Which means by doing absolutely nothing, my existing slices just got mathematically larger.
Yes.
My claim on their future cash flows actually increased.
Precisely. It naturally inflates the earnings per share metric because EPS is quite literally the net income divided by the number of shares.
Right, it's just a fraction.
Yeah, so if you divide the same income by a smaller number of shares, the EPS naturally goes up. But, beyond the simple arithmetic, you have to look at the psychology of the move here.
What do you mean?
This is management looking at their massive cash reserves, looking at where their stock is currently trading, and explicitly telling Wall Street, we believe the single best return on our capital right now, better than opening new stores, better than acquiring another brand, is investing in ourselves.
Wow. Yeah.
They are basically screaming that they believe the stock is deeply undervalued relative to the cash they know they're going to generate in the future.
That is exactly what you want to hear from a leadership team. I mean, they are putting their money where their mouth is.
Exactly.
But we aren't here to just read the press release and cheerlead, right? We have to poke holes in the thesis.
They have to find the friction.
We have to look for the friction. And when I comb through the margin data, I definitely see some friction. Let's translate some of this Wall Street jargon for a second. The gross profit rate for URBN actually decreased slightly. It dropped by 16 basis points to 36.6%.
Right. And just for clarity for everyone, a basis point is just 1/100th of a percentage point.
Right.
It is how the financial sector measures these microscopic fluctuations. So a 16 basis point drop means their gross margin went down by 0.16%.
Okay.
To put that in plain English,
Yeah.
for every single dollar of revenue URBN generated at the register, they kept roughly 36.6 cents in gross profit after paying for the actual physical cost of the goods they sold.
Okay, so it dropped slightly. My immediate reaction as an investor reading that is, wait, are they losing their pricing power? Did production costs suddenly spike? Why did that number go backward while top-line revenue went forward?
Yeah, and if you just scrape the headline numbers into a spreadsheet, an algorithm might flag that as a bearish signal.
Right.
But this is exactly why you have to actually read the source material and understand the underlying context. That slight 16 basis point dip was not due to poor operational performance or some sudden reliance on heavy discounting or a breakdown in their supply chain.
Okay, then what was it?
It was almost entirely due to a mathematical illusion based on the comparison period.
What do you mean by a mathematical illusion?
So in the exact same quarter of the prior year Q1 of fiscal 2026, they received this sudden one-time benefit of $5 million that boosted their gross margin.
Ah, yeah.
Yeah. When you were doing year-over-year comparisons and the prior year contains this sudden unrepeatable windfall, it makes the current normal year look artificially weak. It just sets an impossibly high bar.
Okay, I get it. So it's like comparing your current salary to a year where you won like a $5,000 lottery scratch-off.
Yes. Perfect analogy.
Your core earning power didn't go down this year. You just didn't get lucky twice.
Exactly. And when management stripped out that anomaly, they noted that their core operational metrics actually improved.
Oh, really?
Yeah. Their overall markdown rate, which is, the amount they are forced to discount clothes to get them off the racks, actually got better.
So they are selling more at full price.
Yeah, they were driven by incredibly strong full price selling, particularly at Free People and Urban Outfitters. The core business of selling clothes for what the tag says they cost is actually healthier than ever.
Okay, I'm glad we cleared that up. But I am going to push back on you regarding another line item that caught my eye. And this one isn't a mathematical illusion.
Right, let's hear it.
Let's talk about SG&A selling general and administrative expenses. This is the overhead. This is the cost of keeping the lights on in the stores, paying the corporate staff, marketing the clothes. SG&A increased by a whopping 12% year over year.
That is correct.
Now, I read the fine print. I know that 12% increase was actually softened by a $7 million benefit they received from resolving some legal matter.
Right.
Which means the underlying expense growth was actually even higher than 12%. So let me present this to you. Revenue grew by 11%. Overhead expenses grew by 12%. SG&A deleveraged by 5 basis points.
Okay, I see where you're going with this.
Think of this company like a high-performance stock car on a racetrack, right?
Okay.
They're out there setting record lap times, moving $1.5 billion in revenue. The car is driving faster than it ever has. But if the SG&A is growing faster than the revenue, that means the engine is running hotter and hotter to achieve those speeds.
The friction is increasing?
Exactly. The cost of fuel and maintenance is outpacing the velocity of the car. Eventually, doesn't that engine just blow up? Like, are they just buying top-line growth by spending recklessly? Should we be worried about this expense bloat?
It is a fantastic analogy, and honestly, it is exactly the right question to ask. Expense bloat is the silent killer of retail.
It really is.
But to answer your question, you have to dissect the actual components of that SG&A increase. Because in corporate finance, not all spending is created equal. There is what we call bad weight, and there is healthy weight.
Okay, define the difference for us.
Bad weight is bloated corporate overhead. It's signing disastrous 10-year leases on massive flagship stores in dead malls.
Right.
It's an inefficient, leaky supply chain. It's spending millions on vague brand awareness campaigns that don't actually convert to sales. That is the kind of friction that blows up the engine.
Okay, so what's healthy weight then?
Healthy weight, on the other hand, is capital specifically deployed to build the muscles of the business to ensure future speed and compounding efficiency.
Okay, so parse the transcript for me. What kind of weight is this 12% increase? Where exactly did that money go?
According to management, this increase was heavily concentrated in 3 specific areas. First, store payroll.
Meaning paying the retail workers.
Right. They had to spend more money paying retail staff because physical store sales and foot traffic grew significantly.
Well, yeah, that makes sense.
If you have a massive influx of customers in the store pulling items off the racks, you physically need more humans on the floor to assist them and ring them up. That is the definition of healthy weight. You never want to starve a growing sales channel of labor.
Fair enough. You have to staff the registers if the lines are getting longer. What was the second area?
Heavy, aggressive marketing investments across several of the brands. But again, this wasn't just shouting into the void.
It wasn't just billboard ads.
No, management specifically quantified the return on that ad spend, noting that these investments drove double-digit new customer acquisition.
Okay, that's a crucial distinction right there. They aren't just paying to re-engage the same customer who's already going to buy a sweater. They are actively paying to acquire brand new market share.
Exactly. And in the subscription and apparel world, acquiring a customer today who will ideally shop with you for the next 5 years is an investment, not an expense.
Right.
But the third driver of the SG&A increase is the most important, and it answers your engine analogy perfectly. They are making massive upfront investments in technology, specifically around artificial intelligence.
Ah, okay. We are definitely going to dedicate a huge portion of our discussion later to exactly how they are using AI, because I think it's the linchpin of the whole company right now.
It is. It really is. But just to satisfy your concern about expenses right now, they are deploying massive capital into custom AI customer service agents, machine learning algorithms for inventory allocation across global warehouses, and generative AI tools for their creative and design teams. So, back to your stock car. It isn't running dangerously hot. What management is actually doing is pulling the car into the pit lane and proactively installing a multi-million-dollar turbocharger while the race is still going on.
That's a great way to look at it.
It costs a tremendous amount of money up front, sure, and it hits the SG&A line today, but it is entirely designed to drastically reduce operational friction in the long run.
I can accept that premise. If you are building infrastructure to lower future costs, that is definitely healthy weight.
Right.
And that macro view of their finances transitions us perfectly into understanding the actual machinery of the business. We know the total revenue is up, but that $1.5 billion isn't spread evenly across the brands.
No, it's definitely not.
It's actually masking a massive divergence between their established players and their aggressive disruptors. We really need to look at who is actually pulling the weight here, because right now, the undisputed MVP of this entire portfolio is the Free People Group.
Calling them the MVP is almost an understatement. Yeah, the numbers coming out of the Free People Group are, quite frankly, staggering for a mature apparel brand in this environment. Total revenue for the group surged 17% year over year.
And what makes that 17% so mind-blowing is the context.
Yeah.
Like, they weren't comparing against a terrible year.
Right. It wasn't an easy comp.
They didn't have a weak Q1 last year that made this year look like a huge bounce back. They just posted their 24th consecutive quarter of positive retail segment comps.
It's wild.
Now, for anyone new to retail analysis listening right now, a comp, or comparable sales metric, is the holy grail.
It really is.
It only measures sales in physical stores or digital channels that have been open for at least a full year. It completely strips out the artificial revenue growth you get from simply opening brand new stores.
Yeah.
It shows you the true organic underlying demand for the brand.
It measures the actual health of the relationships with the consumer, right? Like, are they coming back?
Right. And they have had 24 consecutive quarters of positive comps.
That's it.
6 full years. Think about what the world has been through in the last 6 years.
Oh.
We had a global pandemic that completely shut down physical retail.
Yeah.
We had generational double-digit inflation that crushed discretionary spending. We had a total collapse of the global supply chain where container ships were just stuck outside of ports for months.
All of that.
And stylistically, we had a massive generational aesthetic shift from like millennials' skinny jeans and fast fashion to Gen Z parachute pants and thrifting.
Right. Totally different vibes.
Every single macro and micro variable was thrown at this company. And for 6 years, Free People just kept growing.
Right.
How is that mechanically possible?
It comes down to a dual-pronged attack on the market. They have effectively built two different growth engines under one roof.
Okay, break it down.
So the core Free People brand, the bohemian lifestyle aesthetic, is still incredibly strong. That segment grew total revenue by 12%, with their wholesale business up 16%.
Okay.
But the true explosive exponential growth that is driving these massive numbers is actually happening in FP Movement.
Which is their dedicated activewear and athletic performance line.
Yes. And FP Movement didn't just grow. It basically exploded with 32% growth.
32%.
Yeah, they posted a 15% retail segment comp. But the number that should really make you sit up in your chair is their wholesale growth. FP Movement posted a shocking 48% wholesale growth.
Let me make sure I understand the implication of that. 48% wholesale growth means that other third-party retailers like department stores, specialty boutiques, gyms are literally begging to buy FP Movement inventory to put on their own shelves because it sells so incredibly fast.
That is exactly what it means. It is the ultimate validation of brand heat.
Wow.
When other retailers are buying your product at an almost 50% higher clip than last year, you are aggressively taking market share from the legacy players.
You are eating someone else's lunch.
Exactly. And the brilliance of FP Movement is in its strategic positioning. Sheila Harrington, the CEO of the Free People Group, made a very astute observation on the call.
What did she say?
She noted that FP Movement's appeal has evolved far beyond the core Free People bohemian customer.
Right, so they aren't just selling yoga pants to the woman buying their flowy floral dresses.
Exactly. They have successfully engineered this brand to sit at the absolute intersection of technical athletic performance and elevated premium style.
So they are going right for the jugular. They are hunting the Lululemon and Alo Yoga core customer.
Without a doubt. They are executing incredibly strategic, high-visibility partnerships. For example, they collaborated with Barry's Bootcamp.
Oh, smart.
Yeah, and they launched a massive presence in Selfridges in London. That kind of placement goes far beyond just selling athletic apparel. It is about building premium brand equity and cementing cultural relevance in the high-end fitness space.
Okay, so Free People is the current MVP driving the bulk of the profit today. But if we are looking at URBN as a long-term investment, if we're looking for the future growth engine that could fundamentally alter the valuation of this stock, we have to talk about Nuuly.
Oh, we definitely do.
And I'm fascinated by this business model. For anyone unfamiliar, Nuuly is URBN's clothing rental subscription service.
Right.
You pay a flat monthly fee. I believe the current price is around $98 a month. You get to pick 6 items of clothing to rent for that month. It can be from any of URBN's internal brands, but they also offer hundreds of third-party vintage and designer brands.
Which is a huge draw for the consumer.
Huge draw. You wear them, you send them back in a reusable bag, and you pick 6 new items for the next month.
It sounds incredibly appealing to the consumer, right?
Very.
But from a business perspective, the underlying unit economics of clothing rental are notoriously brutal. Historically, it has been an absolute margin killer.
Why is it so hard to make money renting clothes? I mean, you get the inventory back, right?
Because the logistical friction is just immense. In traditional retail, you ship a shirt to a customer once, and the transaction is over.
Done.
Right. In a rental model, you are dealing with constant reverse logistics. You have to pay to ship the heavy box out. You have to pay to ship it back.
Which isn't cheap.
No, it's not. And when it arrives, you have to inspect it for damage. You have to run it through an industrial, specialized dry cleaning process.
Oh, right. Because a sequin dress requires an entirely different chemical treatment than like a denim jacket or a delicate silk blouse.
Exactly. You have to repair lost buttons or minor tears, and then you have to photograph it, inventory it, and store it until someone else wants it.
That sounds like a nightmare.
It is. The sheer cost of human labor and specialized warehousing required to facilitate that cycle is exactly why companies like Rent the Runway have struggled so mightily to show consistent profitability.
The overhead just eats all the subscription revenue.
Exactly.
But Nuuly appears to have completely cracked this code. Looking at the data, they delivered massive 35% revenue growth year over year.
It's incredible.
They added 110,000 average active subscribers. They're currently sitting right on the doorstep of 500,000 active paying users.
Let's do some quick mental math to understand the scale of what they have built here.
Okay, let's hear it.
You have roughly 500,000 subscribers, paying essentially $100 every single month. That is $50 million in recurring, highly predictable revenue hitting the balance sheet every 30 days.
Wow.
They have basically built a $500 million annual run rate business from scratch.
And recurring revenue are the two most magical words you can whisper to a Wall Street analyst.
Oh, they love it.
It completely changes how you forecast cash flow.
It does. But the most vital piece of information from the earnings call is that Newly is no longer a cash-burning, loss-leading startup project.
They were actually making money on this?
Yes. The transcript explicitly detailed that Newly generated $10 million in actual operating profit this quarter. That translates to a 6% operating profit rate.
So they are scaling the user base by 35%, handling all of that complex reverse logistics, and still dropping actual profit to the bottom line.
Exactly. That operating leverage proves that their specific logistical model, the algorithms they use to predict wear and tear, the automated cleaning facilities they built in Pennsylvania and Missouri, it actually works at scale.
They figured it out.
They have achieved profitable unit economics in a sector where almost everyone else has just failed.
I have a massive, very provocative thought about how Newly changes the entire valuation of the URB and ticker, but I want to save that for our final analysis.
Sounds good. We'll put a pin in it.
Before we do that, we have to check in on the rest of the portfolio.
Yeah.
The namesake brand, Urban Outfitters, has had a pretty choppy few years, but it seems to have really found its footing again this quarter.
They did. Total UO sales grew over 11%, and they posted a global retail comp of 9%.
And I love digging into the how of that 9% comp.
Yeah.
Because the 18 to 28-year-old demographic is notoriously fickle.
Oh, extremely.
You can't just put up a billboard and expect them to show up.
Yeah.
Management highlighted how they are drastically diversifying how they reach this younger buyer. And one detail in particular was brilliant, I thought.
The DoorDash thing?
Yes. In April, Urban Outfitters officially launched a partnership with DoorDash.
From a logistical standpoint, treating retail stores like micro-fulfillment centers for a food delivery app is just fascinating.
It's the ultimate catering to the instant gratification economy.
Yeah.
Picture the scenario. You are a 20-year-old college student. You have a party in 2 hours. You hate everything in your closet.
A classic emergency.
Right. Instead of driving to the mall, you just open your phone, order a new top on DoorDash, and it literally arrives at your dorm room alongside your pad thai 45 minutes later.
It's genius.
They are removing every single point of friction between the impulse and the transaction.
Absolutely.
Furthermore, management noted a major shift in their marketing strategy. They are moving away from paying massive fees to traditional mega influencers, and instead, they are leaning heavily into user-generated content UGC for their campaigns.
Which is so much cheaper and more effective for Gen Z.
Exactly. It creates a much more authentic, grassroots, community-oriented connection with a generation that is highly skeptical of polished corporate advertising.
We also need to touch on Anthropologie because their quarter was a perfect case study in operational agility.
How so?
They actually had a noticeable stumble early in the quarter. Management admitted they struggled heavily in February to clear out slower-moving winter products.
This is a classic retail trap.
It is.
If winter weather lingers longer than expected,
Yeah.
or if your specific heavy coats just don't resonate with the buyer, you're stuck with dead inventory on the floor.
Yep.
And dead inventory is a nightmare because it traps your working capital. You can't buy new spring clothes because your cash is tied up in unsold winter coats.
Exactly. And usually, retailers panic in that scenario. They slash prices drastically, which destroys their margin, just to free up the cash.
But Anthropologie didn't panic.
No, they held their nerve. And as fresh spring receipts began hitting the store floors in March, they saw an immediate, sharp recovery in demand.
The consumer responded instantly.
Right. By the time the dust settled, they finished the entire quarter with a positive 2% comp, which, while smaller than Free People, still marks over 5 years of uninterrupted positive comps for the Anthropologie brand.
That's incredible consistency. And the data noted strong performance in women's pants, denim, and dresses. But they specifically called out continued improvements in their furniture segment.
The furniture is a gold mine.
From a business perspective, the math there is beautiful. Selling a $3,000 velvet sofa, even with the shipping costs, does absolute wonders for your average order value compared to selling a $40 scented candle.
Absolutely. The home and furniture category remains a massive white space for them to continue expanding their margins. They have the aesthetic trust of the consumer. Now they're just capturing a larger share of her wallet.
Okay, here's where I want to interject. Because as I was reading through the source material, I noticed a glaring contradiction between the macroeconomic reality of the world and the numbers URBN just reported.
Okay, what stood out?
Specifically regarding Europe.
Let's explore that.
Anyone who reads the financial news knows that the European high street is heavily struggling right now. Consumer confidence across the continent is incredibly low.
It's rough over there.
And specifically in places like Germany, exorbitant energy prices and inflation are absolutely crushing discretionary income. The overarching macro narrative from almost every other company is that the European consumer is tapped out.
Right.
Yet in this earnings call, URBN reported that their European retail segment produced a remarkable 12% comp.
12%.
They're posting massive double-digit gains in a geographical market where their competitors are flatlining or actively filing for bankruptcy. How on earth are they defying macroeconomic gravity over there?
It's an excellent observation, and it really forces us to ask a critical question. Who exactly is the URBN customer?
Right.
This 12% growth isn't magic, and it isn't some accounting trick. It is a textbook case of vacuuming up market share in a highly fragmented, distressed environment.
Okay, unpack that for us.
The CEO, Dick Hayne, addressed this apparent contradiction directly on the call. He pointed out that economists have been writing endlessly about the concept of the K-shaped economy.
Okay, let's break that down for the listener really quick.
Yeah.
A K-shaped recovery or K-shaped economy refers to the widening gap between demographics.
Right.
The wealthy, upper income earners go up the top arm of the K. They accumulate more wealth, their assets appreciate, and their spending habits remain largely unchanged by inflation. Meanwhile, the middle and lower income classes go down the bottom arm of the K. Their wages stagnate, inflation eats their purchasing power, and they are forced to drastically tighten their belts and trade down to discount retailers.
Perfectly explained. And Hayne was incredibly blunt about where URBN sits on that letter.
Top or bottom?
Top. He stated categorically that URBN's core customer base resides firmly in the top half of that K-shaped economy.
Makes sense given the price points.
Exactly. Despite the daily noise of inflation, energy crises, and geopolitical turmoil, their specific consumer remains financially secure. They aren't trading down. In fact, Hayne explicitly said, and I quote, "They are more interested in fashion than price."
More interested in fashion than price.
Yeah.
If you are an investor, that might be the single most beautiful sentence a CEO can utter. That is the holy grail of retail. That signifies supreme pricing power. If you have the right aesthetic, the right silhouette, the right trend, that specific customer genuinely does not care if the jeans are priced at $90 or $110. They aren't comparison shopping. They just want the jeans.
And because the broader European retail market is so weak right now, the weaker, highly leveraged competitors are retreating.
They're pulling back.
Yeah, right. They're scaling back their inventory, cutting their marketing, or closing their doors entirely. That retreat leaves a massive vacuum in the marketplace.
URBN just steps right in.
URBN is swooping into that backing with highly desired product, specifically leveraging the Urban Outfitters and Free People brands. And they are effortlessly capturing all of that stranded market share. They are winning because their competitors are forfeiting.
That makes perfect sense. Now, before we move into looking at the future, there was a major strategic narrative transition announced on this call regarding the Free People group that we have to discuss.
Yes, the strategic shift toward what management is calling progressive diversification.
The CEO of the Free People Group stated that they have reached a critical inflection point in their evolution. Moving forward, they are no longer going to treat Free People and FP Movement as a parent brand and a sub-brand.
Yeah, they're splitting them up.
They're officially decoupling them into two entirely independent ecosystems. Help us understand the logic here. Why undergo a massive administrative and operational shift to separate them?
Because management recognizes the sheer, unadulterated scale of the opportunity in front of them. Let's look at the DNA of the brands. Free People is a premium bohemian lifestyle brand.
Right.
FP Movement is an aggressive activewear and performance disruptor. Yes, there is obviously some customer overlap, like the woman buying the dress might also buy the sports bra.
Sure.
But structurally, they serve genuinely different market opportunities, different use cases, and different competitive sets.
So they need to operate differently.
Exactly. By decoupling them, URBN can pursue both massive markets with a singular, dedicated focus. They actually brought in a new president, Andrea Perez, specifically to lead the standalone FP movement brand.
Wow, so a dedicated leader just for that.
Yeah, and they are planning over 20 new, dedicated, standalone FP movement retail store openings this year alone. They realize that to truly take down Lululemon, you can't just tuck your yoga pants into the back corner of a Free People boutique. You have to build a standalone empire.
It's a brilliant strategic maneuver. It's like having two distinct apex predators hunting in entirely different biomes. One is dominating the boho chic landscape. The other is aggressively hunting in the athletic wear space.
Right.
But beneath the surface, they still share the exact same digestive system. They share the same massive warehouses, the same supply chain logistics, the same corporate infrastructure.
I love that analogy. You get the specialized, hyper-targeted brand identity on the front end, but you maintain the massive compounded economies of scale on the back end.
Exactly. All right, that covers the story behind the current numbers. Now we need to transition to our next major focus, management guidance.
Looking ahead.
This is where we stop looking at the rear view mirror and start looking through the windshield. What is management projecting for the remainder of the year?
Well, looking ahead to Q2, management is projecting high single-digit total sales growth.
Okay, that's solid.
Breaking that down by segment, they expect retail segment comps to be in the mid-single-digit range. They expect Nuuly to maintain its aggressive mid to high 20s revenue growth.
So growing fast.
Yeah, and they expect wholesale, driven heavily by FP movement, to produce mid-teens growth.
Okay, so the top-line revenue narrative remains incredibly strong. Demand isn't slowing down. But what about the bottom line?
This is where the dark clouds start to gather. This is where the friction really appears.
Oh, boy.
Management explicitly warned that they expect Q2 gross profit margins to be flat to down approximately 25 basis points compared to last year.
Down 25 basis points. So their profitability on every item sold is actually going to shrink slightly. Why? I mean, if consumer demand is so high and they have supreme pricing power where the customer cares more about fashion than price, why are their margins contracting?
It comes down to two massive, entirely uncontrollable macroeconomic factors that are completely outside of URBN's operational control: tariffs and fuel.
Okay, let's unpack the tariff situation first, because reading through the transcript, it sounded like an absolute geopolitical circus.
It is a legal circus, honestly.
Walk the listener through exactly what is happening with these import taxes, because it heavily impacts the unit economics of this business.
It is incredibly messy, so let's try to organize it chronologically.
Please do.
Last spring, the federal government imposed what were known as IEPA tariffs. In certain regions like India, where URBN sources a massive amount of their textiles, woven goods, and finished apparel, these specific tariff rates reached a punishing 50%.
50%. Just pause and think about the math on that.
It's brutal.
A 50% tax just for the privilege of bringing your own goods across the border. If a sweater costs $10 to manufacture, it suddenly costs $15 before it ever reaches a warehouse.
Right.
That absolutely destroys your initial markup, or IMU. You either have to eat that cost and ruin your margin, or pass it to the consumer and risk killing demand.
Exactly. It's a brutal tax. And URBN was forced to pay these exorbitant 50% rates from August of last year all the way through the start of this current fiscal year.
That's a huge hit to cash flow.
It is. However, this spring, the courts officially declared those specific IEPA tariffs to be illegal.
Okay, so if the courts rule the tax was illegal, URBN gets all that money back, right?
Yes. They filed the necessary paperwork for refunds, and management expects to receive a massive $100 million cash refund at some point in the second quarter.
Wow.
Yeah, they're going to record this as a one-time benefit on the balance sheet.
$100 million in straight cash just dropping from the sky. But reading the guidance, the story obviously doesn't end with a happy refund.
No, it definitely doesn't, because immediately after the court struck down the IEPA tariff, the administration quickly scrambled and imposed a brand new, different tariff, a 10% Section 122 tariff on almost all imports starting in mid-March of this year.
Okay, well, a 10% tax is obviously much better than a 50% tax, but it's still a massive, unexpected hit to your margins that you didn't budget for.
But here's the ultimate kicker, right? Just recently, those new Section 122 tariffs have also been ruled illegal by the courts.
You have to be kidding me.
I am not.
Wait, so they ruled it illegal, but they still have to pay it?
Exactly. Because of the slow bureaucratic appeals process in the government, URBN is still legally required to continue paying this illegal 10% tax right now.
That is insane.
They might eventually get another refund years down the line, but their actual cash is tied up today. And furthermore, they have absolutely no idea what will happen when these current tariffs officially expire at the end of July.
Will they be renewed? Will a new tariff take their place? It is total uncertainty.
Total uncertainty.
So as an executive team, how on earth do you run a multi-billion-dollar global supply chain? And how do you give accurate earnings forecasts to Wall Street when the fundamental tax code of your supply chain changes every single month based on unpredictable court rulings?
You have to model conservatively. You have to plan for the worst.
Right.
Management stated that based on bilateral trade agreements that are currently being negotiated in the background, they are assuming some form of tariff will remain indefinitely.
So what are they telling Wall Street?
So to ensure they don't overpromise to investors and then miss their numbers, they are deliberately modeling a flat 15% blended tariff rate across the board for all imports in the second half of the year.
That is incredibly smart expectation management.
It really is.
They are baking the worst case scenario right into their guidance. If the actual tariff eventually comes in at 10%, they get a surprise benefit to their margins and look like heroes.
Yep.
If it comes in at a modeled 15%, they've already telegraphed it to Wall Street, the stock won't be punished, and they just execute the plan.
It is prudent leadership. But tariffs aren't the only headache dragging down their margins. We also have to talk about fuel and freight.
Right. The earnings calls specifically call out the ongoing geopolitical conflict in the Middle East as a direct threat to their profitability.
Right.
We are talking about the severe disruptions in the Red Sea and the Suez Canal. Because of security threats, massive shipping containers full of inventory are being forced to abandon the quick route through the canal and take massive, fuel-heavy detours all the way around the Horn of Africa.
Precisely. And the longer the physical voyage, the more days at sea, the more fuel burned.
Naturally.
And the global freight companies don't absorb those costs. They pass them directly on to retailers like URBN in the form of fuel surcharges.
Ouch.
Management was very transparent and quantified this exact impact. These specific surcharges are creating a 70 basis point unfavorable impact per quarter.
Let's break that 70 basis points down mechanically. How does that hit the business?
It hits them twice, basically. It's a 45 basis point margin hit on inbound freight. That is the cost of getting the finished clothes from the manufacturing factories in Asia on a boat across the ocean to the massive distribution centers in the United States.
Okay.
Then it's an additional 25 basis point hit on outbound delivery, the fuel required for the trucks to ship the individual packages from the warehouse to your front door or to stock the retail stores.
Man.
It is 70 basis points of pure margin erosion caused by geopolitical events they cannot control.
It feels like URBN is a world-class athlete running a marathon.
How so?
Well, the underlying athlete, the consumer demand, the brand equity, the product design, the newly subscription growth is incredibly strong. They are out there setting a record pace.
Right.
But these geopolitical fuel costs and these chaotic illegal tariff policies are like strapping a 50-pound weighted vest onto the athlete.
Great analogy.
They are still running fast, they are still winning the race, but that heavy vest is just continually dragging down their overall efficiency and margin.
That is a perfect visualization of their current reality. But here is the most critical part of this entire analysis, and it's what separates URBN from the retailers who just complain about the macro environment.
Which is what most of them do.
Right. But management isn't just complaining about the weighted vest. They are aggressively investing massive amounts of capital to build stronger internal muscles to carry it. They're basically engineering their way out of the problem.
Let's talk about that engineering. Tell me about their capital expenditures. Where exactly are they spending their cash to build these muscles?
Well, management announced they plan to spend $475 million in capital expenditures for fiscal 27.
Almost $500 million.
But the breakdown of that $500 million is what's truly fascinating. Only 35% of that budget is allocated for retail store expansion.
Okay.
Yes, they are opening 54 new stores, heavily weighted toward capturing market share with FP Movement, Free People, and Anthropology. But that is the minority of the spend.
Which leaves 65% of the budget, over $300 million, for non-customer-facing infrastructure.
Exactly. 50% of the total capex is dedicated entirely to logistics.
Oh.
They are massively expanding capacity and deep automation in both their notably subscription fulfillment centers and their traditional retail distribution centers.
So robotics and stuff.
Yeah, they are spending millions to automate their warehouses, using robotics and software to drastically offset the rising cost of human labor and to optimize the efficiency of that expensive outbound freight.
Okay, and what about the rest of the budget?
The final 15% of the budget is pure technology investment, specifically focused on integrating artificial intelligence into every facet of the business.
Okay, let's do a deep dive on the AI aspect, because the Chief Technology Officer, Dave Hayne, sounded incredibly bullish on how this is going to transform the underlying economics of the company.
He really did.
When you read other earnings calls right now, AI is usually just a buzzword thrown in to keep investors happy. But URBN is actively deploying it at scale.
They absolutely are. They aren't just running beta tests, it is integrated.
Like, what are they doing?
Well, they have deployed Google's Gemini models across the entire corporate structure. They are rolling out Anthropic's Claude. They are using highly advanced AI for personalization and recommendation algorithms on their e-commerce websites to increase conversion rates.
Very smart.
They are using machine learning for sophisticated order fraud screening.
They even mentioned launching custom AI customer service agents to handle routine inquiries faster and significantly cheaper than a human call center.
Right.
But the specific application that jumped off the page to me was how they're using AI to accelerate the product development life cycle. Explain the mechanics of this, because I think this is the silver bullet.
This is arguably the most crucial application of technology for a fashion retailer in the modern era. To understand why, you have to understand the traditional apparel life cycle.
Okay, break it down.
Historically, from the moment a designer sketches a concept on a piece of paper, to sourcing the specific fabric from a mill, to manually cutting the patterns, approving the fit, manufacturing thousands of units, putting them on a boat, and finally getting them onto the store floor.
That sounds like it takes forever.
That entire process can take anywhere from 9 to 12 months.
And 9 to 12 months is an absolute eternity in the fashion world.
It really is.
If your buyers predict the wrong shade of green or the wrong silhouette of denim 12 months in advance, you are completely doomed.
Yep.
The clothes arrive, the customer doesn't want them, and you are stuck with millions of dollars of inventory that you have to aggressively mark down by 60% just to clear the floor.
Exactly.
And those markdowns absolutely slaughter your gross margin.
Precisely.
Yeah.
That long lead time is the root cause of the chaos we talked about at the beginning of the show.
So how does AI fix this?
By utilizing generative AI to assist in rapid trend forecasting, automated digital pattern making, and streamlining the complex communication and technical specs with overseas factories, URBN is attempting to drastically shrink that 9 to 12-month lead time.
So they can react faster.
If AI can help them cut that time in half, the business transforms.
Because the closer you can make the manufacturing decision to the actual moment of consumer demand, the more accurate your inventory will be.
Exactly. Higher inventory accuracy equals significantly more full price selling.
You aren't guessing what the customer wants, you are responding to what they want in near real time.
Yes. And more full price selling equals drastically higher gross margins.
So if we tie this all together, the massive AI and technology investments are the direct, engineered antidote to the tariff and fuel headwinds.
They are.
They are creating internal operational leverage and supply chain speed to completely offset the external macro friction. The weighted vest of tariffs and fuel might drag them down by 100 basis points, but if AI-driven inventory accuracy increases their full price selling and boosts their margin by 150 basis points, they still come out ahead.
That is the exact mathematical thesis management is executing right now.
Okay, we have covered an immense amount of ground today. We have looked at the staggering $1.5 billion in record revenues.
We did.
We dissected the mechanics of their massive $300 million share buyback. We explored the explosive 48% wholesale growth of FP movement and the profitable scaling of the Needy rental subscription.
All of it.
We talked about the strategic brilliance of decoupling the apex predator brands and the ongoing battle between supreme consumer demand and brutal macro supply chain costs. It is time for the bottom line.
We promised the listener a highly actionable, opinionated takeaway. We need to distill this deep dive into a clear signal.
And as the expert who has analyzed every line of the source material, I want you to make the final call. Based on this exhaustive analysis of their operations, their guidance, and their macro environment, What is the bottom line for the retail investor listening to this right now? Are we bullish or bearish on URBN?
I take a decidedly strongly bullish position on this stock for the retail investor who has a medium to long-term time horizon.
Okay, strongly bullish. Why?
And the core foundational reason for that bullishness is that the sum of the parts valuation of this company is simply too strong and honestly too misunderstood by the broader market to ignore.
Expand on that concept a bit. What exactly do you mean by a sum of the parts valuation in this context?
Well, the broader algorithmic market and many legacy analysts still largely value the URBN ticker as a traditional mall-based apparel retailer that is entirely subject to the chaotic whims of teen fashion trends.
Right, the old narrative.
Exactly. They assign it a low multiple based on that outdated perception. But our extensive analysis today proves that narrative is factually incorrect.
It just isn't true anymore.
Right. When you buy a share of URBN today, you are not buying one thing. You are buying a highly profitable, mature apparel and home goods business in Anthropologie and Urban Outfitters.
Okay.
You are simultaneously buying a rapidly scaling, high-growth activewear disruptor in FP Movement that is actively taking massive market share from legacy giants like Lululemon.
That alone is huge.
And crucially, you are buying a high-margin recurring revenue subscription tech platform in Nuuly.
You're essentially getting a highly diversified ETF of completely different retail concepts packaged inside a single ticker symbol.
Exactly. And beyond the brands themselves, the executive management team has proven over 24 quarters that they possess the operational discipline to consistently generate record profits despite global chaos.
Right.
And they have the financial prudence to execute massive $300 million share buybacks to reward shareholders when they believe the market is severely mispricing those underlying assets.
Okay, so if I am a listener currently holding the stock in my portfolio, or if I'm looking to initiate a new position on Monday morning, what is the actionable advice here?
What to watch out for?
Yeah. What is the specific granular metric I need to monitor in the next 3 quarterly earnings reports to know if your bullish thesis is actually playing out?
Do not just blindly focus on the headline top-line revenue growth. Revenue is great, but it doesn't tell the whole story.
Okay, then what is it?
The absolute key metric you must watch is their gross profit margin in direct relation to their AI deployment commentary.
Why that specific relationship?
Because the massive fuel surcharges from the Middle East conflict and the chaotic, unpredictable tariff landscape are stubborn realities. They are not going away anytime soon.
Right, the weighted vest is staying on.
Exactly. Your bullish thesis hinges entirely on management's ability to utilize these new AI infrastructure tools to drastically speed up inventory turns and increase full price selling. If you see their gross margins starting to expand or hold steady in the coming quarters, it proves that their internal AI efficiencies have successfully neutralized the 70 basis point fuel headwind and the 15% tariff drag.
So they out-engineered the problem.
Exactly. If gross margins expand despite the macro storm, the underlying profitability will explode and the stock will run significantly higher.
That is incredibly clear, logical, and highly actionable. Now, I want to leave the listener with one final provocative thought. A thesis to mull over, or perhaps explore on your own, that builds on the foundation of everything we just discussed today.
Oh, I'm ready. Let's hear it.
We spent a lot of time talking about Nuuly, their clothing rental subscription model. We established the facts. 500,000 active subscribers growing at an astonishing 35% year over year. And most importantly, it is already generating $10 million in actual operating profit in a single quarter because they cracked the reverse logistics code. It is a mathematical certainty that if this current trajectory holds, Nuuly is on a direct path to hit $1 billion in annual recurring revenue with expanding profit margins in the very near future.
That is a very realistic data-backed projection.
So here's the thought I want you to consider. In finance, there's a concept called multiple expansion.
Oh, this is good.
A traditional brick-and-mortar clothing company usually trades at a very low multiple, maybe 10 or 12 times their earnings, because retail is viewed as risky and capital-intensive.
Yep.
But a tech-enabled subscription platform, a company with highly predictable, sticky, recurring revenue, like a Netflix or a Spotify, trades at a massive premium multiple, often 30, 40, or 50 times their earnings.
Because recurring revenue is the most valuable commodity in the stock market.
Exactly. So my question is, at what point does Wall Street wake up? At what point do the analysts look at $1 billion of high-margin recurring revenue sitting inside URBN and decide to stop valuing the entire company purely on the depressed multiples of a mall retailer?
That's the million-dollar question.
At what point do they carve out Newly in their models and start assigning URBN the massive premium valuation multiple of a tech-enabled subscription platform?
I mean, if the market re-rates the stock with a tech multiple, the upside valuation expansion alone would be massive, regardless of what the physical retail stores do.
Exactly. You are buying the stock today at a massive discount because the sign on the door says it's a mall retailer. But the engine inside is slowly transforming into a highly profitable, recurring revenue tech platform.
It's a great point.
It is something to seriously think about and model out for yourself before you place your next trade. Because remember our opening thought, you expect retail to be a wooden ship in a hurricane. You are conditioned to expect chaos.
Right.
But when you finally take the time to look under the hood of what URBN is meticulously building with AI supply chains, subscription logistics, and decoupled brand ecosystems, you realize you aren't looking at a wooden ship at all.
No, not at all.
You are looking at a precision-engineered machine that is specifically designed to fly right through the storm.
Beautifully summarized. The data certainly points to a company that is controlling its own destiny.
Thanks for joining us on this deep dive. We will see you next time.